Have you ever heard the saying, you have to spend money to make money? Well, what if I told you the world's richest people have a different version of that saying? It's more like, you have to borrow money to make even more money. It sounds crazy, right? We're all taught that debt is a bad thing, a financial trap to be avoided at all costs. But for billionaires like Elon Musk, Jeff Bezos, and the legendary John D. Rockefeller, debt is one of their most powerful tools for building and expanding their massive empires. Today we were going to pull back the curtain and reveal the secrets of how the super rich use debt, not just to get by, but to get ahead. Way ahead. Stick around because this might just change the way you think about money forever. Let us start with a basic concept that is key to understanding this whole strategy: good debt versus bad debt. For most of us, debt means credit card balances with sky-high interest rates. Or maybe a car loan where the car loses value every single day. That's bad debt. It takes money out of your pocket. But the wealthy, they focus on good debt. This is money they borrow to buy assets that will grow in value or generate income. Think real estate, businesses, or stocks. The goal is simple. The return on the asset they buy has to be higher than the interest rate on the loan. If they can borrow money at 5% interest to invest in something that gives them a 10% return, they're literally making money with the bank's money. It's a concept called leverage, and it's like a financial superpower. Let's take a look at one of the godfathers of this strategy, John D. Rockefeller. Back in the late 1800s, Rockefeller wanted to dominate the oil industry, but he didn't have all the cash on hand to buy out every competitor. So what did he do? He went to the banks. He borrowed heavily to acquire refineries, pipelines, and transportation networks. His competitors, who were more cautious and afraid of debt, couldn't keep up. Rockefeller understood that by using borrowed capital, he could grow his company, Standard Oil, much faster than if he only used his own profits. He created a monopoly that controlled almost all of the oil in the United States. He wasn't afraid of debt, saw it as a tool for rapid expansion and consolidation. He was playing a different game than everyone else, and it paid off spectacularly. Now let's fast forward to the modern era and look at someone like Elon Musk. We think of Musk as this genius inventor and innovator, but he's also a master of financial engineering. Take a look at his companies, Tesla and SpaceX. They require mind-boggling amounts of capital to operate and grow. Do you think Musk pays for all that out of his own pocket? Not a chance. He and his companies have taken on billions of dollars in debt. But it's strategic debt. This money funds new factories, research and development for new rockets, and the expansion of the Starlink satellite network. These are all investments designed to generate massive future returns. Musk isn't just building cars and rockets. He's building assets that are projected to be incredibly valuable, all fueled by borrowed money. But here's where it gets even more interesting for billionaires personally. It's a strategy often called buy, borrow, die. Let's break it down. First, they buy or build assets like stocks in their own companies. As the company grows, the value of these stocks skyrockets. Now, if they wanted to access that wealth, the normal way would be to sell some stocks. But selling triggers a huge tax bill on the capital gains. Billionaires hate paying taxes. So instead of selling, they borrow. They go to a bank and take out a massive loan using their stock portfolio as collateral. Because they are borrowing against such valuable assets, they get incredibly low interest rates, often just 1 or 2%. Think about it. They get millions or even billions in cash to spend on whatever they want, a new yacht, a private island, or just their living expenses, and they pay almost no tax on it. Why? Because loan proceeds aren't considered income. They've unlocked the value of their assets without selling a single share. They can live a lavish lifestyle, and all the while, their original assets are still growing in value. As long as the value of their assets grows faster than the tiny interest on their loans, they're coming out ahead. And what about the last part of buy, borrow, die? Well, that's the die part. When a wealthy individual passes away, there's a rule in the tax code called the step-up in basis. This means that the value of their assets, like their stock portfolio, gets reset to its market value on the date of their death. Their heirs inherit these assets at this new, higher value. If the heirs then decide to sell the assets to pay off the loans, they pay capital gains tax only on the appreciation that happened since they inherited it, which is often very little. In many cases, Those massive capital gains accumulated over a lifetime are completely wiped out for tax purposes. The original loans get paid off, and the family is left with a massive, tax-free inheritance. It's a brilliant, multi-generational wealth preservation strategy. Jeff Bezos is another master of this game, but you rarely hear about him selling large chunks of his stock. Instead, he periodically pledges his shares as collateral to secure lines of credit from banks. This gives him access to billions in cash to fund his other ventures, like his space company Blue Origin, or to make personal investments. He gets the liquidity he needs without having to sell his Amazon shares and trigger a taxable event. He's using the wealth on paper to create more wealth in the real world, all while minimizing his tax burden. So what can the average person learn from this? But the core principles can be applied on a smaller scale. The first lesson is to understand the difference between good debt and bad debt. Racking up credit card debt to buy things that lose value is a losing game. But what about taking out a loan for education that increases your earning potential, or a mortgage to buy a house that will appreciate over time, or even a small business loan to start a company? These can be forms of good debt or leverage that can help you build wealth. The key is to be smart and strategic. You have to do the math. Will the asset you reacquiring with debt generate a return that's higher than the interest you're repaying? It's about shifting your mindset from seeing all debt as an enemy to seeing some debt as a potential tool. The wealthy don't fear debt. They respect it and use it with precision. They understand that using other people's money, when done correctly, is one of the fastest ways to build your own fortune. Of course, this strategy isn't without risks. If the value of your assets falls dramatically, the bank might make a margin call, demanding you put up more collateral or pay back the loan immediately. This can force you to sell assets at the worst possible time, leading to huge losses. This is what happens during a market crash, and it's why even billionaires aren't invincible. But they mitigate this risk by being heavily diversified and by not over-leveraging themselves to the point of collapse. In conclusion, the way billionaires use debt is a world away from how most people think about it. It's not about financing a lifestyle they can't afford. It's about financing a future they want to build. They use debt as an accelerator, a tool to amplify their wealth and expand their empires at a speed that would be impossible with cash alone. From Rockefeller's oil monopoly to Musk's space ambitions, leverage has been the secret ingredient. By understanding the principles of good debt, strategic borrowing, and the buy, borrow, die strategy, we get a fascinating glimpse into the financial playbook of the ultra-rich. It's a powerful reminder that sometimes the rules of the money game are different at the top. Thanks so much for watching. If this video opened your eyes to a new way of thinking about wealth and debt, be sure to hit that like button and subscribe for more content that dives deep into the world of finance and success. Let me know in the comments what you think about this strategy. Is it genius or is it too risky? I'd love to hear your thoughts. See you in the next video.